Shall we kick it off? So, thank you to everyone who's joined. I'm so excited to welcome you all to this discussion of ESG's second act. And we've seen that climate proposal volumes and excitement from shareholder activists remains really high in the climate-related ESG space, but the past couple of years have seen significant backlash to that agenda, at least as it's currently being framed in some proposals. Just this week, we saw that the $54 billion Texas Permanent School Fund, which invests for Texas schools, announced that it's adopted what it's calling an ESG skeptical voting policy. The fund says it'll assess shareholder proposals at companies' annual meetings and vote against any attempts to pressure companies to diminish the use of fossil fuels or proposals that oppose gun rights, among other things. And in that climate, the Center for Active Stewardship has been thinking really creatively about shrewder framings of climate-related proposals, as well as the space more generally, and tracking some of the developments. So I'm really excited to jump in, and we have a terrific set of panelists today. So we have Nolan Lindquist, who's executive director of the Center for Active Stewardship, which just launched a fascinating interactive tool called Splice, breaking out emissions that you should go check out, and that I was lucky enough to write about earlier this week as it launched. We have Marian Macindoe, who's head of ESG stewardship at Parnassus Investments. Michael O'Leary, who's partner and co-head of impact at Catterton, and Jessica Witt, who's U.S. head of ESG research at Barclays. And we're going to dig into what their roles look like in a little bit, but first I'm going to turn it over to Nolan to take us through some of his recent research.
Thanks, Lee, and thanks to everyone who's online for joining. The Center for Active Stewardship is super excited to be hosting this panel and to have such a great moderator and a great roster of panelists. I'm going to share a few quick words about CAS. We're a research nonprofit incubated by the Jane Family Institute. We focus on the intersection of climate issues and the public markets, particularly when there is a proxy voting or corporate governance angle. And the title of this panel is ESG's Second Act. CAS is primarily focused on climate and primarily focused on transition risk. But I want folks in the audience to know that we haven't forgotten that ESG is much broader than that. And we're excited to talk about a much broader range of sustainability topics with our excellent cast of guests who know a lot more about the S than I do. But I thought to just level set and to provide some context for the discussion, I would quickly flip through some simple data-driven slides outlining how CAS is looking at this year's proxy season. So we look at a universe of climate-related shareholder proposals put forward through the 14A-8 process in the US, aimed at getting public companies to either enhance disclosures or set more ambitious targets on climate issues. In recent years, that's been about 150 to 200 proposals a year. Interestingly, this year we're looking at a little bit less than 150, which is down a bit from the peaks seen in the 2022 and 2023 cycles. I think the high-level trend that you see in these charts is going to be pretty familiar to certainly the panelists, but probably the audience as well. We've all probably read about, BlackRock and Vanguard and some of the other asset management giants pulling back on their support for climate-related shareholder activism relative to the heady days of 2020 and 2021. And you see the output of that when you look at climate proposal success rates over the past 5 cycles, and then looking ahead to this year. It's continued to trend down after peaking back in 2021, which coincidentally, or maybe not so coincidentally, was also the year when fund flows to sustainable mutual funds and ETFs peaked. If you look under the hood at the topics that these proposals address, there are really 5 big, broad topics that cover about 2/3 of the distribution. The biggest of which by far is, of course, greenhouse gas emissions targets. The nuance here is that in a world where an increasing number of companies have set some kind of absolute or intensity-based emissions target, or at the very least have a long-term aspiration to reach net zero, most of these GHG target proposals are really about the structure and the ambition of proposals. Often the ask is implicitly, if you already have a long-term target, please instate short and medium-term targets and share those with investors. Or if you have a target that's not particularly ambitious, try and align, if possible, with the Science Based Targets Initiative's guidance for your sector. If you look at the success rates broken down by category, the interesting trend is that far and away the most successful group of proposals is proposals that are actually directed at non-CO2 greenhouse gas emissions. So that's methane, it's refrigerants. Those proposals have continued to succeed at pretty high rates, whether by winning a majority of votes from shareholders at an annual meeting or being withdrawn by proponents voluntarily. Even in the 2023 proxy voting cycle, which saw pretty poor results for most of these proposals. By sector, it's no surprise that energy is a little overrepresented in the universe of shareholder proposals on climate relative to its weight in the S&P 500. What's maybe a little less obvious or a little unexpected is that the consumer categories, staples and discretionary, as well as financials, are highly overrepresented relative to their weight in the S&P 500. This slide, I think, covers the really important trend that we see, which is that, whether you're looking at it in terms of emissions intensity, so scope 1 and scope 2 emissions, or scope 3 emissions divided by revenue, or you're trying to actually convert that into some measure of financial materiality, what we like to do is multiply emissions by some illustrative carbon price and divide by some sales or earnings metric. We like to use EBIT. The materiality of emissions at the companies that have been targeted by these campaigns has continued to fall over the past few cycles. When you look at scope 1 and scope 2, which that's direct emissions and then emissions from purchased electricity and heat. And I think this illustrates a big disconnect. Activists are very focused on scope 3. They want companies to tackle full value chain emissions, including upstream emissions released by suppliers and downstream emissions from sold products. A lot of investors are a little skeptical of that and prefer to focus on material scope 1 and scope 2 emissions. And so what you see is, as the financial materiality of these more direct emissions categories has fallen, support from investors for these activist proposals has tended to fall as well. That's really the big regularity that we see over the past couple annual meeting cycles. Looking a little deeper at the distribution of emissions by sector, I think an important thing to note is that direct emissions, which CAS uses that term a little loosely to cover both scope 1 and scope 2, tend to be concentrated in a few sectors: utilities, energy, materials. Scope 3 emissions are found in a wider range of companies, and there are a lot of industrials and a lot of consumer companies that have very high scope 3 materiality. The key thing to note, though, is that it's not just your emissions today that matter, it's the direction of travel. You can plausibly argue that the financial materiality of today's emissions extrapolated on a business as usual basis into the future is more like a ceiling than a floor for the financial materiality of emissions. And the reason for that is that companies that have some kind of greenhouse gas emissions target in place, or that seem to be making strides if you just look at the trend in historical data on energy intensity and on the emissions intensity of revenue. A lot of those companies are taking steps that reduce the net present value of future emissions. And what that means is we need to be really careful about thinking about the sort of carbon liability that's lurking as kind of like an off-balance sheet liability for many companies. And we need to think really carefully about whether existing emissions targets are actually good enough at mitigating that carbon liability, even if they're not aligned with an aspirational net zero or science-based framework. I think that's a nuance where a lot of these campaigns have had a hard time winning over single bottom line or returns first investors in recent years. If you look at the population of companies that have been targeted by these proposal campaigns, 70% of them have some kind of existing greenhouse gas emissions goal in place, whether that's an absolute goal, an intensity-based goal, or both. And if you look at the distribution of emissions reduction goals in terms of the linear annual reduction in emissions that they imply, the average is falling around 4% for those companies that are targeted by proposals and that have an absolute emissions goal. And 4%. I mean, there are companies that have more ambitious goals than that, but 4% is pretty good, as far as I can tell. And so I think making the case that the desired targets that a proposal is asking for are really going to add value from a financial materiality perspective is going to be an increasingly high bar for these proposals to clear with a lot of investors. So to close things out, I'm going to editorialize just a little bit and sort of share the CAS view of the world, which I hope that our panelists rebut and disagree with and add some context to, because it's no fun if we all agree, right? We all want sparks to fly on a panel like this. What I would say is we think about transition risk as policy risk, right? If global policies converge on whatever is needed to drive net zero and deliver on the commitments of the Paris Agreement, what's the sort of net present value of those climate policy sticks? And what's the net present value of those policy carrots? Obviously, there's going to be a wide range around those estimates, right? Just like there can be a wide range around analyst estimates of key financial indicators. But this is the right framework, I think, for really thinking about how to relate sustainability issues, or at least transition risk issues, to the bottom line. And what I would say to add to that is, if CO2 prices are going to rise over time and emissions are going to decline over time, what that means is, because of discounting, the present value of your net transition risk is often going to be a lot smaller than you would think if you're just looking at today's emissions times a carbon price divided by operating income divided by earnings, whatever denominator you think is most relevant. We like to use EBIT, like I said before. In the US, but I think we can generalize, because policy instruments like the IRA are gaining popularity globally, has really increased the value of climate carrots, particularly for companies that want to play on the molecules side of the energy transition. And that's really important. If you think that, like, ExxonMobil's Scope 1 and Scope 2 emissions are going to decline in the future, i.e. looking out 10 or 20 years, direct emissions are fairly front-loaded. And if you think that they're going to invest a lot in carbon capture and storage and in hydrogen and in other categories where they're going to be eligible for these new tax credits, what the IRA has done is it's really, really reduced the size of the net climate policy liability that was lurking on ExxonMobil. I'm just using them as an example because they're the biggest emitter in absolute terms in the S&P 500, but you can generalize this to any company. green industrial policy is really reducing the value of the net climate risk that was previously lurking on a lot of emissions intensive companies' balance sheets. I say on their balance sheets. It's not a real financial liability, but it's more of an analytical exercise. Finally, I would just say, now that reporting tends to be aligned with SASB and TCFD standards, and in fact, now that these standards have been integrated into various securities regulators and financial market regulators, rules and regulations in much of the world, particularly in developed markets, evaluating these climate proposals requires much deeper engagement with company strategy and with industry and company level trends. It's no longer just as easy as identifying gaps in reporting or gaps in disclosures relative to some widely agreed upon standard that pretty much everyone has signed up for. And so what I'm hoping to do with this panel, and Lee's going to drive the conversation, but my hope is that we really dig into this financial materiality issue, because I think increasingly evaluating the financial materiality of these proposals is not so black and white. And that's especially true when you look at the 70% of proposals that go beyond set some greenhouse gas emissions targets. When you look at proposals that are digging into plastic waste, supply chain issues like deforestation and water use, just transition issues, which are sort of the intersection of the E and the S, I think analysts and activists alike are going to have to be a lot more creative in thinking about what makes a proposal financially material and what is the pathway for the ask of a proposal driving value creation at a company. And so with all that said, we have some great guests. They're here to talk about the different frameworks and themes they apply when thinking about the financial materiality of these issues. I expect to talk a lot about this year's proxy season, but I'm sure the conversation will kind of, color outside the lines a bit and dig into other contexts. Though I would say, if you look at the panelists who have joined us, there are a lot of folks with a lot of experience with shareholder activism, particularly in Michael's case. I'm sure he'll talk about it, but Michael was formerly at Engine Number One. Marian thinks about stewardship and proxy voting issues at a largely public equities focused asset manager. Jessica wears a lot of different hats, but has written about these issues in her client notes recently. So excited to talk about things in the context of proxy season, but I definitely don't think this conversation will be limited to that frame.
Great. Thanks so much, Nolan, for all the interesting provocations. I'm especially excited to get to the materiality point. But maybe, so I briefly introduced our guests, but maybe you could go around and tell us a little more about your work and how your job has changed or evolved in this space in the past year or two. Maybe tell us kind of concretely what you're seeing, to speak to some of the themes that Nolan raised. How do you strike a balance between quantitative and qualitative inputs in your analysis? Are there metrics that you think are overrated or underrated in this space, or that you're using to kind of translate climate talk into more material sort of decision useful information for companies? And then just explain to us a little bit how your job links to the proxy voting space. So maybe if I could pick on Marian and start with you, would you tell us a little bit about your work in this space?
Yeah, thank you, Lee, and thank you, Nolan. This is great. What an interesting conversation. A great time to have it too. I'm the managing director of sustainable investing at Parnassus Investments, a $50 billion asset manager. We have 6 strategies, 5 equity, 1 fixed income. They're all active, and they're all sustainable investing strategies. By way of background, I have worked in this space, the space formerly known as ESG, for almost 20 years. This is my 20th proxy season, which is how I measure the passage of time. It's not coffee cups, it's how many proxy seasons have you been through. I've had 4 jobs before this one. 2 of them are at companies, at Uber and at Chevron, where I helped them build out performance and disclosure strategies around environmental, social, and governance issues. I was a director of investment stewardship at Charles Schwab Asset Management, where I set their proxy voting policies and voted for Schwab funds. And I was 7 years as director of ESG and proxy research at Glass Lewis, which is one of the 2 leading proxy advisory firms in the United States and globally. And the common thread, you may seem like an erratic career pattern, but frankly, the common thread across all of these jobs, including the one where I'm sitting now, is that they sit at the intersection of investors and sustainability. And all of these jobs have a focus on value and on delivering shareholder value. And that's my job and my role at all of the jobs that I've ever had. So for 20 years, I've made the same joke, and I pity people who've known me that long because I've heard it a lot, which is that when I go to work, I stop caring about people and the environment because my job is to serve shareholders. So I hang up my I care about people hat, and I put on my Mr. Monopoly hat, and I twirl my mustache. But the important part, and I always hope my mic doesn't get cut off, I think I'm a sociopath, is that it's the same story, right? This is not mutually exclusive. It's the same story. And that's our philosophy at Parnassus, and the root of all of my work is that if you don't take care of the natural and human capital on which your business relies, your employees, your customers, your fence line communities, regulators, et cetera, your business, Parnassus business, every business for everyone on the call, you won't be successful in the long term, right? If you don't take care of the natural and human capital you rely on, you won't be successful. And that's how companies should approach this. And it's how investors, long-term investors especially, should be approaching this. We have 3 tools, and with great hubris, I'll say that all asset managers have 3 tools which they can use, which is screening. And let's be honest, like every asset manager is using, active asset manager is using screening in some way, whether it's screening out moat or relevance, balance sheet, leverage, sustainability. And that's a tool that you use up front to say, hey, we're going to focus our time on the highest quality investment opportunities that we have. Then idiosyncratic review of individual stocks, which is stock selection, and using ESG or sustainability related criteria to help choose companies that are going to be winners and companies that are not. And then finally, stewardship, which is where proxy voting engagement and industry advocacy come in as well. So my job at Parnassus, I do all 3 of those things. I've worked here for a little over 2 years, and I can tell you that since I started, one of the biggest issues that we've had to grapple with, and everyone else has too, is this introduction of anti-ESG rhetoric and reinforcing a belief internally, asking ourselves the questions like, are we doing this right? Like, is this the way we should be doing this? What should we be doing in our portfolio companies, and how should we be applying frameworks and our thinking to these categories of decision making? And then reinforcing the idea that this is about materiality and long-term success of the businesses in which we operate. So I'll stop there. I know there were a lot of questions, but I can answer those throughout the rest of the panel too.
That's great. Jessica, you want to come in?
Yes, thank you so much, everyone. So my name is Jessica Witt, and I lead ESG research for Barclays here in the US. I joined Barclays a couple of years ago. Prior to that, I held a similar role leading the ESG research and integration efforts for an asset manager for the emerging markets business. And prior to that, I was an investor on the same team. I come at this having spent most of my life, most of my career as a research analyst, much of that on the buy side. At Barclays, we're working across equity, credit, and macro, so integrating ESG and publishing on topics across all these different asset classes. That being said, so much of my background is in equities that I spend a lot of time with that department. I'm going to try to hit most or some of the questions that came up. Kind of how's my job been recently? I think it's interesting because we've seen all these negative headlines on ESG, but my day to day is so different. We have never been busier. Our team is a relatively new one, but we're speaking to more and more clients like every day on all manner of ESG topics. We're finding more and more ways to work with analysts across the firm on different ESG considerations that are impacting their coverage. So I think that suggests that there's a real disconnect between some of the negative rhetoric that you hear on ESG and the reality. To sort of clarify, my connection to proxy voting, it's obviously my role as a sell-side analyst now, not part of my day-to-day. But one of the topics that I've really enjoyed that we've been writing about over the past couple of years is what we're seeing. Looking through all the data, looking at the trends, we think it's important, both for companies and investors. These all are in the spotlight in terms of how they handle these proposals. So it's been an increasingly, I think, important topic, and we see clients having to put more and more resources and thought into these proposals.
Great, Michael, if you want to come in, yeah.
Sure. I'm still thinking about Marian walking to the office of Parnassus every day and putting on her Monopoly Man costume. Well, thank you guys. It's great to be here. As Nolan said, I've been engine number one during the Exxon campaign. I'd helped to launch a series of ETFs focused on engagement and voting, and now at a firm called Catterton, where I do impact investing, focused mostly on consumer companies. And I think the way my job has changed most for the last couple of years, it's more a matter of degree than of type. But I think there is this increasing focus on being able to make a very direct connection between anything within the broader world of ESG and make a very, very clear and direct financial case for why others who may be disinterested or maybe actively antagonistic against a given topic should care. And my experience has always been that these debates become least political when they are most concrete. And that if we were to have a broader debate about, is ESG investing good or bad for the world? Should it lead to higher return or lower return? We can argue and argue and argue forever. But if instead we're debating whether a specific company should expand production in a specific product set at a specific time, suddenly you're dealing with something that's much more tractable, much less political. And my experience within the consumer world oftentimes is that the way you can do that most effectively is by showing where is there real demand, where are there real market opportunities, where are consumers adopting specific products, not just because of some altruistic aim, but because they also think this product is more convenient or more efficient or more cost effective. I think you've seen the uptake of technology like heat pumps, for instance, being motivated primarily not by some concern around the environment, but because it is more cost efficient and effective for many homeowners today. And that's how we get past that 50% mark of adoption of heat pumps versus gas furnaces in the last couple of years. So I think making that connection as direct as possible and in the least political way as possible ultimately ends up being a lot of where myself and the folks on this call and more broadly the movement are spending a lot of our time now.
Great. Maybe to go to the materiality discussion that Nolan framed for us so nicely, we could dig into that a little bit more. I mean, for one thing, so Nolan's kind of provocation was whether analysts and activists need to be more creative in delivering this stuff up and in describing materiality. Is that right? Where has the backlash, to the extent we've seen it, left us on these questions of materiality? Maybe should we question the premise of declining support for proposals in the first place? Maybe I'm overstating that kind of backlash narrative. But to the extent that it's there, maybe you could talk about whether there's a slightly different theory of change around how to present materiality. And I guess one more thing to put on the table is there's been increasing talk about transition plans. Is that something that you're finding useful, and kind of what are the do's and don'ts of publishing a transition plan from the point of view of a public company?
Then maybe I'll just pop in for a second because I have things to say. And I think, the most important thing for me about materiality, when I think about materiality, which is what the whole question is, right, is about materiality and how the reasonable investor is making decisions. I always think about one number, which is 90%. 90% of the S&P 500 value is intangible now. And in 1975, that number was 17%. So we're thinking about more than a complete reversal. And if you took all the physical assets owned by all the companies in the S&P 500, the cars and the office buildings, you put them in your yard with a sign and your Monopoly Man mustache, you're going to get less than 10% of the value of the index, right? And what's wrapped up in intangibles, of course, is intellectual property, trademarks, patents, licensing, but also your reputation, human capital, the ability to attract and motivate the best talent, the ability to attract customers, and be granted the license to operate. And that's not just figuratively. In many cases, it's quite literal. The literal license to operate, you can see it getting snatched away. And the contours of materiality are really different than they were in 1975. And another number that I think is 15 billion, which is the number of cell phones, smartphones that are in the world right now. And all those smartphones have cameras and they have megaphones and apps that can blast your opinion out about companies and about your workplace and about products in ways that is new and in a way that we're all grappling with and trying to understand. And it changes the contours of liability and accountability and opportunity around ESG issues more than any others. And all of these changes in materiality and what tangible and intangible trade-offs are, it changes what investors need from companies, right? It changes the information that investors and companies need to make decisions. So if you're ever looking at what kinds of information do investors need and what is material as a company, you have to be able to be dynamic when you're thinking about what is the information that a reasonable investor needs to make decisions, and how has that changed since we first set up the program to determine what materiality is? Are we looking at these issues in the right way?
I can jump in. I may switch the order of the questions, but thinking a little bit about that question, where has backlash left us? I mean, I think, here in the US, there's a lot of discussion around, proposals having become more incremental and not sufficiently material. That being said, one thing that's difficult to deny is that there's a very different level of support out of the US versus Europe on some of the same set of proposals. And I think when you look at that divergence in support levels, you have to acknowledge that the backlash has had an impact, and hence like why we're here, talking about how important it is, how important materiality is. So I think that then kind of segues into the first question: do analysts and activists need to get more creative? I would say definitely yes. I think materiality can be a function of a lot of things, and one is time frame. And I think building in different considerations into how you craft the proposal, and making that line to materiality more evident. How could some regulation take effect? We've seen, some of my colleagues have written about different regulations that have really surprised the market. So one of my colleagues last year wrote about deforestation. That regulation came up very quickly, and it was a big surprise to companies, and there has been a measurable impact. So, seconding what other speakers have said on the call, a lot of these, natural and human capital issues, they do have value. The question is, sometimes that value can be on a very long time frame or a very unpredictable time frame, and maybe proposals could do a better job of connecting those dots.
It's a good point. I mean, one final thought to add here, maybe for Michael, is the challenge I always find in reporting on this when people point out that the sort of more climate friendly or ESG friendly option is increasingly the cheaper one, is then just to ask what kind of additionality the sort of ESG push brings in the first place, because presumably companies will be making those investment decisions themselves if they're sort of optimal. Now, something like deforestation, I think, is a really interesting example where it seems like the public sector is actually pushing the market in a direction that may not be, optimal for their balance sheets, but there the public sector is leading. And so, oh yeah, Nolan, please come in.
Lee, sorry, I didn't mean to cut into that interesting discussion. I think some really sharp points from Marian and Jessica on this. What I would say is, having over the past, I was going to say a few months, but really since jumping into this seat at CAS, having spent a lot more time looking at corporate ESG reports and proxy filings and CDP questionnaire responses than I did when I was an analyst, because I covered media and internet. So when we talked about sustainability with the companies that I covered, it was like, are you replacing the light bulbs in the TV studios with fluorescents? It was pretty small bore in the grand scheme of like the energy transition. What I would say is, it's hard but not impossible to size what I call carbon liabilities based on reasonable assumptions. And what I mean by that is, you can anchor on existing CO2 prices, you can anchor on a range of scenarios like the IEA's World Energy Outlook scenarios, and you can make some assumptions around how carbon prices ramp over time. The harder part, which is actually really interesting, I would add parenthetically, is mapping where emissions occur to what specific policies are going to be put in place to disincentivize them. And basically what I mean by that is, the where of energy and emissions is supremely important. If your emissions are generated in Texas, the cost of those emissions is not high today, and it is probably not going to be high in the future. If your emissions are in California or the EU, there already is some kind of financial cost applied to those emissions today, and that cost will probably only go up in the future. And so from a pure value creation standpoint, the where is very important to track. But what I would say is, even if you can do that illustrative exercise and, choose a discount rate, run some sensitivities based on the cost of capital and on the carbon price you're applying to future emissions, even if you do that, what's really hard is sizing what I think of as the carbon asset, which is the net present value of the various carrots and incentives that policymakers are going to give you in order to ease your way along the path to net zero as a company. And so that ranges from pretty formulaic instruments like the tax credits in the IRA, where, if I look at, say, a big company's long-term guidance, they will hopefully provide some kind of breakout of their CapEx plans, and I will hopefully be able to map those CapEx categories onto business segments that are being addressed by specific policies. So the easiest way to do this would be basically if I'm kind of articulating a wish list. Like, if I waved a magic wand, this is what I would want. It's way beyond what public companies can consistently provide. But I'm just sort of like articulating this to illustrate what an analyst could maybe try and do with some illustrative assumptions. What I would love is a breakout of CapEx over the next 5 years and some kind of some disclosure breadcrumbs that would allow me to map that CapEx onto X billion dollars will be eligible for this investment tax credit, X billion dollars for this other investment tax credit. So I can really look at, like, okay, under this range of assumptions, what is the net present value of all those benefits I'm getting from investing in these particular supply chains that policymakers want to encourage the development of? And how do I net that against the carbon liability, right? I think valuing the carbon asset is way harder. The disclosures are way murkier. They implicate a lot of forward-looking assumptions. They implicate a lot of like big picture strategic capital allocation decisions. And I think if you're an analyst and you're looking at a sector that's exposed to the energy transition, either because you sell fossil fuels or you generate energy, or you sell capital equipment that is either aligned with burning fossil fuels or with using renewable electricity, I think you're trying to think about the carbon asset. And so I think there's a big opportunity for activists to use shareholder proposals to force companies to provide disclosures that make that valuation exercise easier for analysts. But I think that requires a more strategic and more, frankly, shareholder value oriented perspective than is maybe typical for a shareholder, a 14AA-8 shareholder proposal on climate.
Can we get some reactions to that before a couple more questions?
Well, the first thing I would say is, we are not meant to run our companies by proxy. When the system is working well, these are all considerations, exactly as Nolan laid out. These are all considerations management should be making themselves, and we're able to use this sort of extraordinary tool of proxy voting to, in some ways, as companies stray too far from what's reasonable, what should be reasonably expected of them, to kind of knock them back in. And not being a shepherd myself, clearly, I think the metaphor stands. It's like a shepherd with a flock, and when a sheep strays too far one direction or the other, we use this tool of proxy voting or shareholder activism, and through that you get the entire herd to move in one direction or another. And I think it's worth keeping in mind, especially for folks who do not spend as much time as everyone on this panel does thinking about proxy proposals, that when we look at these headline figures like what percent support did the average environmental proposal get this year, that the denominator, the actual proposals being put forth, are themselves changing year to year. And if we were to have a repeat vote every year, should oil and gas companies be reporting on scope 1 and 2 emissions, something that was more contentious maybe 5 years ago than is today, we wouldn't see declining support the way it's reported right now. We'd see stable or increasing support. But just the way that the nature of proxy voting works, we're always focused on, okay, what's the next frontier? What's the next frontier? And I think as we think about then for the votes that are coming to proxy season this year, so we look back at 2023 and we think about how do we make the materiality case. I'm always reminded of a lesson I learned when I was first working at Bain Capital on the private equity side, when you got all these very sophisticated, intelligent investment committee members, partners, and what you realize is if you can't convince folks with basic arithmetic, where you can show them on pencil and paper in the margins, they can kind of back up the case you're making. If you can't prove it to someone with simple arithmetic, it's be a much, much more difficult climb. And proxy voting is that to the extreme, because you're trying to convince retail shareholders, you're trying to convince folks of every persuasion. And so I think taking the sorts of concepts that Nolan's drawing out and then being able to simplify them as much as possible, so that the average person on the street who has only a passing interest in climate and only a passing understanding of what the company even does will support it. I think it's going to be our best path.
Great. One note is please type your questions in the Q&A box that you should have access to. I see there are a couple questions there already. We're going to turn to those in a second. I just wanted to ask before we go there for our panelists to come in on non-climate issues that they're anticipating. Particularly, I know unionization was a big theme last year, and labor rights. Michael, I know you've focused on kind of keeping the consumer in mind with a number of these issues. What are you hearing, or what are you expecting to see beyond just carbon emissions narrowly?
I'd be curious. I think actually Marian or Jessica would probably have a better sense for what's becoming to proxy vote this coming season. I mean, from my perspective, I think, in some ways we started with what's hardest, in climate, like it's about as close to a pure externality as you can get in thinking about carbon emissions and climate change. And that as we start to focus on some of these social issues like human capital management, how you're treating your workers, the health and wellness of your products, these things, in some ways the economic case should be even clearer. And so I'm hopeful that as they become a bigger part of the conversation, which I think will come, especially as measurement becomes better, as people become more comfortable with it, that we'll make the economic case even more strongly than we are with climate.
Yeah, I mean, I think what's interesting about proxies, and one of the reasons I love them so much, and one reason why they've gotten more difficult lately, is that they are a testing ground for companies and investors to have conversations about new issues. It's the most common and arguably the most important way that a broad base of shareholders talks to the board of directors. Investors talk to management all the time, but it's actually a communication tool with boards of directors. And so what you see is investors bringing new topics about any social issue of the day. And over the course of, not the last 2 years, but before that, you see these proposals being really effective at turning the heads of boards of directors in certain directions to understand the materiality of those issues to the business model and the way companies should be looking at proposals. And I would even say the way most do, or many do, is look at the proposal and try to understand how can that proposal actually add value to my business? How can it add value to my capital allocation or to my strategic decision making? Is our executive compensation on the ballot actually driving the strategic objectives that we want it to, not only from a traditional financial business model, but also for the sustainable and environmental and social and governance objectives that the company has. And I think what you'll see this year, what we're seeing is reproductive rights. You're seeing climate change. You're seeing plastic. I mean, any issue, ethical AI, responsible use of AI, like anything that you're seeing in the newspapers is showing up on ballots. And when you see it show up on a ballot, you're asking companies to almost in some ways take a position on the materiality of that issue for their business. And, I should also say that shareholder proposals ideally are a last resort, right? Nolan, you made a lot of great points about the kinds of things that investors could be asking for or should be asking for to affect change. But with the rules of shareholder proposal and the specific and weird and blunt tool that they are, sometimes you can't ask for that are quite so specific. And you're looking for things that are more social policy objective or higher level, and they're always precatory. The most effective tool that we have is engagements. And it's when engagements are not successful, when you are at an impasse, is when shareholder proposals should be used to take the temperature of other investors. So to answer your question, Lee, we're seeing everything on the ballot. I mean, including an enormous amount of what are called anti-ESG proposals, although I wish there was another name for them, and maybe there is, but it's proposals that are taking a different perspective on these issues. Are diversity programs valuable? Should we be disclosing political contributions? Is climate change real? Right? Like these are different people coming in, and you see them getting low support because they're not material, right? Like that's not what's going to be adding value to these companies over the long term.
I'm second these comments. I mean, I was just about to make the point that a lot of the, in the top couple categories, climate and DE&I, a very large proportion of the proposals that fall under those broad subheadings are from anti-ESG proponents. And then this year, it's seen, I think, so far a big increase in proposals related to lobbying and political spending, much of which ultimately I think does tie back to climate, and also agree on the comments of, this is a last resort. And maybe you'll see the mix of proposals shift a bit once companies and investors have spoken on other topics for a longer period of time. I think climate and emissions have been something that investors have been engaging with companies on now for several years. Maybe something like you'll see more biodiversity related proposals in the future, but those engagements are still ongoing.
Great. Maybe we can open it up to some of the questions we've gotten. So let's see. I'll read a couple. So one person asks, can we hear from the panel on time horizon of investors? Which investors can afford just not to care? Which should be taking a 10 to 15 year time horizon or more? And are we seeing investors act accordingly? Another asks, have you done any work on analyzing ESG impacts on private companies? Data should be available in the BDCs, and how public investors are exposing themselves through those vehicles. And Alex Wilkes asks, the main focus so far has been on transition risk, as I heard it, but what about growing physical climate risks to infrastructure, raw material prices, supply chains? Actually, maybe Nolan, you could speak briefly to that, because I think you've really emphasized transition risk.
Yeah, so I think the physical risk question is really astute. I don't know that I have a super differentiated answer on this. What I would say is, across a bunch of different projects, whether it's our database of proxy voting records, whether it's the thematic energy transition research we do, whether it's tools like Splice, we at CAS focus on transition risk because we think it's one of the more promising areas for identifying win-wins. We've been talking the language of shareholder value on this call, and that's because we're talking about an ecosystem where that's the North Star for most of the actors at play. And also that's kind of my own background as an analyst. But CAS obviously has an impact mandate. It's just that our theory of change is to influence people who have a returns or a profit maximization or single bottom line mandate, whatever you want to call it. And so we think about where those win-wins are, and transition risk is really interesting because there's always a way in theory to connect the dots and say, what you can do is minimize this carbon liability, maximize this carbon asset. And if that's if that screens as a reasonably high ROI decision, you can make those investments. And so it's a way of basically mobilizing the trillions of CapEx needed to deliver on net zero. Physical risk is really important. I would put that more in the camp of adaptation than mitigation. And I spend like 90% of my time, if not more, thinking about the mitigation. And so I don't have as much to say on that as I maybe should, but I think that just reflects the project I run and my own kind of like background and positionality. Others on the call might have more thoughtful points on physical risk.
I mean, I would say if you're a board on a corporate board, if you're on a board of directors and your company isn't thinking about physical climate risks, you should ask why not. Or you should ask them if they're thinking about it and not bringing it to the board level so that you can understand how your company's preparing for this inevitable change, right? 143 degrees. So I like having these Time magazine numbers in my head. It's 143 degrees was a temperature in India. It's a land surface temperature, so it's a little manipulative, but it was 143 degrees in India in April of last year. 101 was the temperature of the water off the coast of Florida last year. I mean, that my dad sets his hot tub to 102, right? Like this is happening. This is happening, and you need to prepare for it. Do you have workers? Do they operate in places where they can be impacted by heat or by smoke? We've had days in California where the sun doesn't come out, right? Like this is at a minimum, it's going to be impacting the insurance rates for your employees, right? So we engage on climate change, we engage on transition, and we also engage on physical risks and adaptation, to use your word, Nolan. And one is like a home builder, right? Like we have a home builder in our fund. They're building homes in Louisiana. You want to make sure that they're thinking about impacts to humidity or sea level rise or any other physical risk, increasing severity and duration of storms. And there's going to be winners and losers. And we just want to make sure that we're picking the companies that are going to be winners and that the companies in our portfolios are planning ahead for this as well. And that's, maybe that speaks also a little bit to the time horizon question is, some of these, you may not have a climate disaster for a really long time, or it might happen tomorrow, right? So these are the kinds of things that you want to be thinking about, ahead of time and not, the day you see it in the news.
Just quickly, I do want folks to get back to the time horizon question and the important question on private companies, but There's a question that I think sort of gets to the heart of the debate that we've been putting on the table. Alan Reed says, with all respect to materiality, many foundations have missions that they advocate for, as do many Americans. What are the most effective ways for investors to inform their managers of those requirements?
I love the framing of that question. I mean, what I would say is it's worth remembering that when it comes to large public companies, you're only as strong or as powerful as the coalition you can create, as a coalition you can bring together. And one lesson from the Exxon campaign that Engine Number One had ran is it had been covered by the press and the media largely within the the context of climate and the energy transition and what Exxon needed to do long term around climate. But if you were to go back and look at all the materials that the team had used when they were out pitching individual firms to support the slate of candidates, the words climate barely even came up. It was very, very much framed in shareholder argument terms. I think the reason is that you're always playing to that marginal voter, and just like in Congress or any other political movement, making the case in terms of they best understand that marginal voter is how you're most successful. And so it's a great point that many folks are way more mission oriented, care way more about climate for its own sake than as we've been talking about it in kind of dollar and cents terms. But I think the reality ends up being still that to get big change at these big companies, you need to be able to make a case that we'll already win the climate folks hands down, but we'll be able to convince those who are much more ambivalent about these sort of topics than we are.
We should wrap up, and I'll hand it back to Nolan, but maybe I'll read one final question and see if Jessica or anyone else wants to come in. Anderson Lee says, shareholder proposals seem to be the coordinating mechanism that we're relying on to meet climate goals and assumes a market view instead of public coordination. Do you think it'll be strong or fast enough to meet the net zero timeline?
That's an interesting question. Unfortunately, it looks like we're not on track to meet that timeline, and we don't have the support rates on these climate related proposals to think that mechanism is going to be how we get there. I think it's certainly one important path, but investors also have a job to do and mandates to fulfill. So I mean, I think ultimately you need policy to get there. I think certainly bringing the private sector and bringing investors into this world can be additive to that process, but it doesn't displace the need for policy. And I hear that from companies, and we hear that from companies in sectors like energy. Well, you want us to do something, you need policy that will then bring that materiality more into sharper focus too.
Great. Maybe that's a good point to wrap up on. Nolan, I'll hand it back to you.
Sure. Thanks, Lee. And I'm always so impressed by the quality of the questions that come in from the audience. When you do a panel like this, a bunch of really thoughtful points. If I can just quickly comment, I think Anderson's question is the right one. I would say that the short answer is no. Market-based approaches are not enough. What I tend to say is what public companies do, and to step back even further, what asset managers do in their role exercising governance rights over public companies is only one very small piece of the puzzle. But I think what we can do is be really thoughtful about what this tool can achieve. But at the same time, I don't think we should burden it with the expectation that it can achieve everything, or even a majority, let's say, of whatever denominator you think is most relevant, probably like like temperature rise, right? Like if you're thinking about the world as largely, if you think the world is headed to like high 2 degree, low 3 degree pathway, and like the value of any sort of tool or instrument in terms of, well, how much of the bridge from that trajectory back down to 2 degrees or ideally 1.5 degrees, like how much juice are we going to get out of this? It's I would say not even half, and probably well under that. But anything we can do to close that gap is quite valuable. And so that's not to say it's a waste of time, but I think it's important to be really clear-eyed about what it's good for. And I would also say the opportunity, I think, in a time of like green industrial policy, where increasingly governments are stepping in and saying through their actions that they want to take the lead in planning the energy transition and driving the investment that'll be necessary to deliver net zero. Many of those policy instruments are based on this idea of catalytic capital. And the idea is that public monies will be levered up by private, either concessional or ideally market rate finance. And so public companies ultimately allocate a lot of the capital that's available to be allocated in any given year, right, across the global economy. And so figuring out how we can tell the story of why allocating the incremental dollar of capital to low carbon projects is an attractive return for corporates, and incentivizing companies to prepare and share the disclosures that enable investors to make those connections, I think can have a lot of value. I think there's a lot of leverage there. I also want to quickly touch on Alan Reed's comment with like a shameless plug of CAS and its projects. Alan, you asked about how investors can highlight their priorities and needs for the asset managers that they work with. I would say probably Marian would be happy to talk to you about that as well, as a senior leader at a responsible investment management firm. But what I would say is many of CAS's projects and tools are geared for doing exactly that. We produce scores and metrics that evaluate how mutual funds and ETFs use their voice as shareholders to weigh in on climate-related proposals. So I would encourage you to check out our fund scores and have a conversation with us about how that tool works, and would generally love to chat about your approach to that. But anyway, to close things out, it's been great to have everyone on. Lee, thank you for emceeing. You did an awesome job. We're always so pleased to bring so many exceptional sustainability leaders together for a great conversation. When I say exceptional sustainability leaders, by the way, I do mean Michael, Marian, and Jessica. I'm not including, but we're in good company, and it's great to share a virtual stage with you guys and have such an interesting conversation. It's been a lot of fun.
Thank you all.
Thank you. Thank you.
Thank you.
Thanks all.